Now speaking, Wendy Kelly, Vice President of Stakeholder and Investor Engagement. Good afternoon and thank you for joining us today for WD-40 Company's quarterly earnings call. Our President and Chief Executive Officer Steve Brass and Vice President and Chief Financial Officer Sarah Heiser are on the call today. We encourage investors to review our earnings presentation, earnings press release, and Form 10-Q for the period ending May 31, 2023 available on our investor relations website at investor.wd40company.com. WD-40 Company posted strong financial results this quarter, with total net sales of $235.3 million, a 6.2% increase compared to last year. Net income increased by 8.6%, from $34.3 million last year to $37.2 million this year. We also experienced growth in gross profit margins, increasing from 56.8% last year to 59.3% this year. In addition to these positive financial results, we have made several new initiatives and announcements that we believe will continue to drive growth and improve operations. These include a reorganization of our business segments, the expansion of our e-commerce offerings, and the launch of a new product line. We look forward to continuing to deliver exciting results and value to our shareholders. Now speaking, Steve Brass, President and Chief Executive Officer. We're seeing a shift in consumer preference towards Smart Straw, which is increasing our average sale price per can. We anticipate this trend will continue and further enhance the growth profile of the WD-40 multi-use product over the long term. Our third must-win battle is increased penetration of our maintenance products into additional end markets. In fiscal year 2022, we made a strategic decision to increase our focus on original equipment manufacturers, OEMs. We are pleased to report that sales to OEMs have increased by 8% year to date. We are also beginning to see traction in other automotive aftermarket channels, such as repair shops, auto parts stores, and car dealerships. We continue to expect this channel to be a key driver of revenue growth for us over the next few years. The fourth must-win battle is to deepen our focus on digital commerce. We've seen tremendous success over the last 2 quarters with a surge in online sales driven by the pandemic and the resulting stay-at-home culture. Customers have been looking for convenience and ease of purchase for their everyday items, such as WD-40 multi-use product. Online sales were up more than 20% year to date and now represent 10% of our total sales. This is an area where we are investing significantly and we have seen encouraging results so far. We expect to see continued momentum in this channel for the foreseeable future. Today I'm happy to share with you that after 2 quarters of flat to down sales, we've returned to solid top-line growth in the third fiscal quarter. Net sales for the third quarter were a new record for the company at $141.7 million, up 15% compared to the same period of last year. On a constant currency basis, sales would have increased 18%. Furthermore, net income was up 30%, reaching $18.9 million compared to $14.5 million last year. Our Americas segment made up 50% of global business in the third quarter and we anticipate sales within this segment will grow between 5 to 8% annually. In our EMEA segment, sales were up 6% in the third quarter to $52.5 million, or 13% on a constant currency basis and in line with our long-term expectations for 8 to 11% annual growth. Our Asia-Pacific segment was up 42% in the third quarter to $18.1 million, primarily due to the absence of supply chain disruptions and favorable impacts from price increases. Over the long term, we anticipate sales within this segment will grow between 10 to 13% annually. To drive these growth targets, we are focusing on 4 must-win battles: 1. Geographic expansion of WD-40 multi-use product, 2. Premiumization of the product, 3. Increased penetration of our maintenance products into additional end markets, and 4. Deepening our focus on digital commerce. Sales of WD-40 multi-use product globally have returned to growth year to date and we are confident that it will finish this fiscal year in growth. Additionally, sales of WD-40 Smart Straw and Easy Reach, when combined, were up 1% year to date. Lastly, we have seen a surge in online sales, up more than 20% year to date, representing 10% of total sales. With these actions, we are targeting a compound annual growth rate for maintenance product revenue in the mid to high single digits on a non-GAAP constant currency basis. Now speaking, Sarah Heiser, Vice President and Chief Financial Officer. Thanks, Steve. Our third fiscal quarter saw top-line growth, despite the continued currency and pricing-related headwinds. We have targeted our gross margin to be at or above 55% of net sales, cost of doing business to 30%, and EBITDA to 25%. Our gross margin was 50.6%, up 290 basis points year over year due to price increases, lower miscellaneous costs, and changes in foreign currency exchange rates. Asia-Pacific experienced a 100 basis point sequential improvement, while EMEA's 700 basis point improvement since its lowest level in the fourth quarter of 2022. Our cost of doing business was 32% compared to 31% last year. Net income for the second quarter was $18.9 million versus $14.5 million in the prior year, reflecting an improvement of 30%. Our capital allocation strategy includes a comprehensive approach to balance investing and long-term growth while providing strong returns to our shareholders. We return capital to our shareholders through regular dividends and buybacks, and our board of directors recently approved a new share repurchase plan so that we can continue our share repurchase activities over the next 2 fiscal years. For the full year, we expect net sales growth between 3.5% and 7.5%, gross margin between 51% and 52%, A&P investment between 5% and 5.5%, provision for income taxes around 21%, net income between $64.5 million and $68.5 million, and diluted earnings per share between $4.80 and $5. Now speaking, Steve Brass, President and Chief Executive Officer. On this quarterly earnings call, we reported an 18% increase in net sales in constant currency for the quarter and 7% year-to-date. We experienced volume-related growth at a consolidated level both this quarter and year-to-date, with WD-40 Multi-Use Product up 16% and WD-40 Specialist up 7% for the quarter and 11% year-to-date. We have also seen tremendous progress in digital and e-commerce, with our e-commerce sales growing 35% in both the quarter and year-to-date. Our first ever global online marketing campaign, Repair, Don't Replace, was recently launched, and we are committed to restoring gross margins to our target of 55%. We continue to return capital to investors through regular dividends and buybacks, and inventory levels are expected to continue to decline for the remainder of this fiscal year. Long term, we are targeting a compound annual growth rate for maintenance product revenues in the mid to high single digits on a non-GAAP constant currency basis. While we are reiterating our guidance today, we do continue to operate in a volatile environment and likely come in at the lower end of our guidance range. D.A. Davidson analyst Linda Bolton-Weiser inquired, "What should we expect in terms of America's sales growth for the next quarter, given the hard comparison to last year's fourth quarter?" Sarah Heiser replied, "Yes, we do anticipate a price increase in the EMEA region in Q4. We saw a larger price increase affect our business in the Americas in Q4 of last year and this quarter. EMEA will experience a similar effect, but at a lower rate compared to the Americas. We expect to see a volume decline globally in the high single digits to low double digits for the full year, including Russia." D.A. Davidson analyst Linda Bolton-Weiser inquired, "Sarah, could you please provide the core volume and price year-over-year excluding Russia for the quarter?" Sarah Heiser replied, "Sure. Price had a 17% impact while volume was close to flat year-over-year, with growth in Asia-Pac offset by losses in Americas and EMEA. We're beginning to see a trend of turnaround this quarter." D.A. Davidson analyst Linda Bolton-Weiser inquired, "What is the expected impact of increased volume and decreased price on the company's overall?" Steve Brass replied, "Steve here. Overall, our U.S. market showed signs of a turnaround in Q3 with point-of-sale volumes becoming neutral and multi-use product up 3%. We're cautiously optimistic that the full fiscal year volume level loss will be in the high single digits." D.A. Davidson analyst Linda Bolton-Weiser inquired, "Can you provide an overview of the renegotiated CAN contracts for 2023 and explain why we are still seeing unfavorable CAN cost comparison?" Sarah Heiser replied, "Overall, the CAN cost for this year has been relatively neutral. We have seen some small decreases in one region and small increases in another which have offset each other. Looking ahead to next year, we are expecting that prices could be more favorable with spot prices remaining where they are now. However, overhead and labor costs to convert tin plate into cans remain high and are not reducing proportionally." D.A. Davidson analyst Linda Bolton-Weiser inquired, "Can you provide more insight into the de-emphasis of your home care and cleaning product lines?" Steve Brass replied, "We have no intention of exiting any of our brands under the household category. We are currently taking a strategic look, assessing our long-term plans. These brands have produced $33 million in revenue over the past few years and we are now focusing on innovation for future sustainability. As it stands today, there are no firm plans to make changes, but we want investors to be aware that we are considering all options." D.A. Davidson analyst Linda Bolton-Weiser inquired, "Can you provide more detail on your debt paydown and share repurchase plans?" Sarah Heiser replied, "We saw a significant increase in cash flow this quarter, which allowed us to pay down debt. Our debt balance is still running about $10 million higher than it was a year ago due to investments in the supply chain. We anticipate paying down more debt over the next quarter or two and then likely use our excess capital for share repurchases." Jefferies analyst Dan Rizzo inquired, "What is the timeline for returning to 55% gross margins, provided input costs remain relatively steady?" Sarah Heiser replied, "Price has been the primary driver in our margin recovery and we expect progress next year towards our goal of 55%. However, it will take time to execute on our supply chain strategies and realize results. So, while I'm not committing to a date, it will likely be longer than a year before reaching that goal." Steve Brass replied, Daniel, our Asia-Pacific trading bloc has seen a strong recovery of 56% at the end of Q3. This is up from 500 basis points in Q4 last year. In comparison, EMEA has recovered 700 basis points since their low in Q4 and are now at 52%. The main issue for the Americas is the high inventory levels purchased at higher cost prices 6 to 9 months ago, which is impacting gross margin. We are working to improve this by reverting to our gross margin strategy of premiumization, international expansion, and WD-40 specialist. Jefferies analyst Dan Rizzo inquired, was there any order timing in Asia-Pacific that impacted third quarter results? Steve Brass replied, yes, there was a difference between our Q3 and Q4 performance in Asia due to the Shanghai lockdown last year. This caused a weaker third quarter performance than usual, which resulted in this year's fourth quarter looking better than normal by comparison. However, overall it was still strong. Jefferies analyst Dan Rizzo inquired, could you explain what caused the inventory write-down in this quarter? Sarah Heiser replied, we encountered some delays and additional costs during the testing of one of our third-party fillers in the Americas. This resulted in a small write-down, however we expect these issues to be resolved as we grow our filler network. We are committed to ensuring that all products meet our quality standards before they are released.